Hello, everyone. Welcome to This Week in Economics with Robert Wenzel. I'm Robert Wenzel. This week's topic is the three kinds of inflation that are going to blow overall price inflation through the roof. Price inflation is about to hit hot and heavy in the United States. There are three factors that are dovetailing to push prices higher at levels we haven't seen in many, many years. I'm going to discuss those three factors, and then I'm going to discuss a fourth factor, which hasn't kicked in yet, but if it does, will push prices even higher. So let's begin. The first uh, price inflation that I'm concerned about is what's known as base inflation. Now, base inflation is coming about because of the lockdowns last year. When the lockdowns occurred, it impacted certain industries in a dramatic degree. Obvious examples are the hotel industries and the airline industry. When the lockdowns hit, these sectors lowered prices dramatically. The airlines dropped prices, hotels dropped prices because there just was not the demand. Now, as the economy is opening up again, as the lockdowns ease, we're starting to see these sectors starting to raise prices again. But they're raising them against a very low base of last year. So the comparisons against last year are going to be show dramatic increases in prices. So from those sectors, we're going to see what's going to appear like a very aggressive inflation. And in a way, it is an inflation, but it's a one-time, one hit that is only occurring because of the major drop in prices last year. So that will probably reflect in the price indexes, government price indexes like the consumer price index for the next 6 months or so. So on top of that, what we're going to see is bottleneck inflation. Now, what bottleneck inflation is all about is the fact that the lockdowns shut down major parts of the economy, and a lot of that is not coming back right away. It's even on an international level. For example, it's extremely hard to get container space right now on ships because there's so much product from China in other Asian countries, for example, that manufacturers and distributors here in the United States want, but they're just not the ships to load it on. As a matter of fact, on the West Coast, we're seeing ships line up trying to get to the docks where their cargo can be unloaded. We're seeing this in Long Beach, California, which is a major port, Los Angeles, and Oakland, California. So you've got tremendous amounts of bottleneck right there, right on the shore. But in addition, it's within the United States itself because a lot of these companies shut down during the lockdown. That's why you have such high unemployment. But here's the thing, because the United States government is paying people regular unemployment, plus there's an additional federal unemployment of $300 a week, there's a lot of people that can earn more money staying unemployed than they can going back to work. So they're staying unemployed. So the businesses that laid people off can't get enough of laborers at the old wage or any kind of wage that makes sense for them to crank up to the old capacity. So this bottleneck is causing a decrease in supply. As the economy is opening up because the lockdowns are easing, what you have is a situation where the supply just isn't there. So from the bottleneck perspective, you're going to see an increase in prices. This is basic supply and demand. There's less supply. So even if demand stays the same, you're going to see increases in prices because there's fewer products available. Now, the third factor is that the demand in terms of dollars is actually going to increase because the Federal Reserve has pumped an enormous amount of money into the economy. Last year in 2020, they pumped over $4 trillion, which increased the money supply by more than 26%. That is a huge amount of money. We haven't seen that kind of money increase in a year in decades, not anything since the World War II era. So it's a huge amount of money. And because it's not stopping, we're gonna even see more money come into the system. Trillions of dollars more this year in 2021. So what happens with all this money if you don't have more product and everybody's got more money in their pocketbooks? What you're going to see is an increase in prices because they'll be able to bid up for goods and services. So remember, we've got a bottleneck of a number of different factors and sub-factors involved with that, from product trying to get into the United States from overseas, from manufacturers trying to crank back up. So we've got limited supply. And at the same time, we've got people have more money. So they're going to be able to bid more for fewer products and services, goods and services. So that is going to mean upward pressure on prices from that direction. So that means we've got increases in prices coming from three directions in the short term here over the next 6 months, 9 months for sure. It's going to be really something to witness. We've got base inflation, which is just the reflection that prices are coming back to where they were pre-lockdown levels. That means airlines, hotels, over time, over the next 6 to 9 months, are going to be able to increase prices from they were last year. So the comparisons are going to be very inflationary. We've got the bottleneck, which is real limitations on goods and services that is occurring. So that's less supply. So that's the supply side of the supply demand equation that indicates higher prices. Then we've got the demand side where we've got the Federal Reserve pumping all this money in. So everybody's got more money in their wallets. With this going on, this is an incredible dovetailing of factors that are going to push prices high. Now, how high? It's always difficult to tell, always hard to make a hard forecast as to a number. Now, I think 3% is in the bag. I think we're going to see annualized 3% inflation without any. I mean, in March alone, for that month, we saw the month of March, we saw an increase from February of 0.6% in prices, which is an annualized rate of 7.2%. And then for the entire 12-month period, we saw an inflation rate of 2.6%. Well, there's no question. I'm very comfortable saying that over a 12-month period, we're going to see inflation at 3%. However, I think it'll probably hit without any problem 5% on an annualized over a 12-month period. So 5% I think is in the bag. Now, here's where things get interesting, because the base inflation thing is only going to be a factor for 6 or 9 months. That's the period when the prices were dropping. After that, the base inflation sort of thing moves away from the picture. Then on top of that, at most it's 12 months if you consider that, well, maybe prices aren't starting to go up at all until now, although I think they started roughly at the first of the year in certain parts of the country. But at the most, the base inflation is going to be a factor for 12 months. Then you've got the supply bottleneck, which I think over time will ease a bit, say in 6 months to 9 months. This extra pay that people unemployed are getting of $300 a week ends on September 6th. So those people will be more willing to go back to work. So that will increase the productivity and the amount of supply coming on. So those two factors are going to sort of end as far as upward pressure on prices. But the inflation thing, we don't know when the Fed is going to stop. There was $4 trillion last year. I expect probably around the same. It could be much higher. You don't really know what the Fed is going to do or when they're going to stop printing. So that's the factor that really needs to be looked at, because that can continue the upward pressure on prices. Now, in addition to that, there's another factor. When people get this money from the Federal Reserve, they don't go and spend it all. They spend a percentage of the new money that comes in, but some of it, for example, goes to the capital goods sector. That is the stock market, real estate. That's why you see the stock market at new highs, why you see real estate prices soaring, why you see Bitcoin going up. It's because money is going into the capital goods sector, into savings, investment, things of that nature. Eventually that trickles down and will put upward pressure on prices, consumer prices. But that will take a little time, and that's going to work its way through the system. But it could very well happen that at some point when people see prices going up steadily, they may say to themselves, hey, I better buy now because prices are going to be higher next week, next month, 6 months from now. And that's when you get an intensification in price inflation that's more than even how much the money supply is increased, because people are really spending that money to get goods now rather than waiting later. So they're willing to bid up, basically every dollar in their wallet to get goods now, because they know the purchasing power is going to dip in a short period of time. So at this point, what we have is a situation where we've got the base inflation that's locked in, that's coming. The bottlenecks are here. That's going to put upward pressure on prices. And we've got money supply where there's just been so much pumped into the system that some of it will get into the wallets of people and they will spend it right away, but they won't spend it all. Some they may just hold as cash, sort of a back reserve. Some may pay off debt. Some may put it into investment instruments. But if they see the inflation heating up because of the first three factors, because of the base, because of the bottleneck inflation, and because of what's trickling out because of the money supply inflation, then you could see a whole new level of inflation. So now I'm conservatively saying 3%. I think we're going to get to 5% on the annualized basis, but the potential could exist for a 10% inflation. I'm not predicting that, but it's not out of the question. Things are going to really heat up. There's going to be inflation like we haven't seen in at least since the 1970s. So we're basically at a situation where 3% is in the bag. We're going to see 3% on an annualized basis. I'm convinced of that. I think 5% is extremely likely, but I'm not ruling out much higher inflation of 10%. There's just so many factors dovetailing to create aggressive inflation in the short term here that it might trigger that mentality that causes inflation to increase at a level that is even more rapid than money supply growth. So 10%, it could go even higher than 10%. We really don't know where it's going to stop. It's just a period when there's no question it's going to get very hot on the inflation front. And then there's the factor of, when does the Federal Reserve recognize the price inflation as a concern and start to attempt to counter it by raising interest rates and slowing this inflation? They're already blaming any inflation that's coming in on the first two factors. They're not blaming it on the money they've printed, although that's a major factor. They're blaming it on base inflation, and they're blaming it on the bottlenecks. And they don't think they should fight that inflation because they think it's temporary. In a way, it is temporary, but that just gets the whole inflation thing going. But they're not acknowledging the inflation that's being caused by the money that they've printed. And it may take them quite a while to recognize that. So they're not going to react to 3% inflation. Whether they react to 5% inflation or not is another question. But I don't expect them, even if they start reacting to 5% inflation, to raise rates high enough so that would choke off the inflation. If inflation is at 5%, you need short-term rates at 6 to 7% minimum to choke off the inflation. The current short-term rate, the one the Federal Reserve controls most directly, the Fed funds rate, the target now is 0.0% to 0.25%. So there's a long way between the top end of that 0.25% to 7.0%. They're not going to move fast enough to get up there, nowhere near it. And so you might have a tiger by the tail situation where inflation heats up, the Fed raises interest rates. Maybe they even raise the Fed funds rate from 0.25% to 3.0%, which would be a dramatic increase in rates. But if inflation is at 5% or higher, that's not going to be enough to stop the inflation, the money supply growth, and all that. And they're going to have to raise it even further, but then the inflation heats up even more before they get there, and you get the tiger by the tail. And then you really need a Paul Volcker kind of guy to come in at the Federal Reserve to just really clamp down on the money supply growth and let interest rates go wherever they have to stop the inflation. And that's what I think will happen somewhere down the road. I don't know when that's going to happen. I certainly don't think it's going to happen in the next 6 months or 9 months. I wonder if Jay Powell's the kind of guy to really slam on the brakes like that. Doesn't seem like he is. He seems like to me like he'll do the tiger by the tail thing. But at some point, the inflation could get way out of control. And by way out of control, I'm saying 10%, maybe more than that. Now, some people talking about hyperinflation, which would be 50% inflation or more. We're not there at that point yet. And hopefully someone within power recognizes the problem when it's at the between 5% and 10% and starts recommending the aggressive steps that need to be taken so that we don't even have to worry about really crazy inflation. But we don't have anybody that's concerned about it now at the Federal Reserve. And that's why we're going to have inflation that is extremely serious, not because of the base and the bottleneck stuff. That's going to put prices up in the short term here. It's because of the money printing. The money printing is incredible at this point. Again, as I've stated, we haven't had this kind of money printing in decades. And if it doesn't stop, the inflation is going to rage until someone comes in and really slams it down. So 3% in the bag, 5% extremely likely, 10% possible. I don't want to predict anything beyond 10%, but I can't really rule that out. But I'm just saying, watch out. Inflation is going to be a lot worse than people expect. And we've got a magic brew of 3 factors that are going to push it higher. And then if it triggers the mentality in the people to start buying now because prices are going to be higher later, then you're going to get to a whole new level of inflation. Let's hope it doesn't get there. Thanks for listening. Be sure to check out my website, economicpolicy.com, where I talk about the economy Monday through Friday, and then I write more on Saturday and Sunday. I don't stop. I talk about economic policy, economic theory, economic personalities. That's economicpolicyjournal.com, economicpolicyjournal.com. Thanks for listening. Talk to you next week.